Let's get across the market open. Marcus Padley joining us from Marcus today. Marcus, welcome back. Good to see you. So let's take a look at what happened on global markets with, well, a focus on Wall Street. Bit of a pullback there. In fact, we did have a warning coming from both Morgan Stanley and Goldman Sachs, fearing of a potential bubble, at least referring to that, and the likelihood of some significant pullback.
Look, Andrew, we've been talking bubbles for a few weeks now, and this is just more bubble talk. So whilst the Nasdaq drops 2%, and interestingly, we've been watching. There are ETFs in the US which pull out the Magnificent Seven, and pull out there's one called XMAG, which is the S&P 500. Excluding the Magnificent Seven, so it's the not so magnificent 493, and it's been interesting to watch the performance of that relative to big tech or the Magnificent Seven. And the Magnificent Seven particularly the last 2 weeks after the Nvidia AI Super Bowl, really propelled Nvidia over 5 trillion, and everything got dragged up with it. And during that period, we've seen the Magnificent Seven ETF up 1.5% a day, whilst the XMAG 7 has been going down. So there's been this huge gap opening up between Magnificent 7 in the last couple of weeks. And I think we've just got a bit of that blowing off. So today, the Magnificent 7's down 2.29% in the US, and the XMAG's down 0.8%. So it's a bit of I think it's just a cooling off. There are all sorts of stories around on big tech, particularly about how data centers are financed, and how a lot of the hyperscalers have rather distanced themselves from the risk that data centers fail is the wrong word, but if they overinvest in data centers, then there's going to be too much capacity around, prices will fall, and an investment in a data center will be a bit of a disaster. Some people are suggesting that the next global financial crisis could be from how many bonds investment banks are holding related to data centers that are not going to be profitable. So the negatives are coming out, but what I think we still lack, whilst interesting to see the market down for a day, the bit we still lack is a real catalyst for big tech to come off. The only catalyst we've got at the moment is bubble talk and overvaluation. I'm not sure that's enough for a precipitous moment in the market, although we might get the average 5-10% correction in the market just as it reprices, but it's nothing seismic at this point.
Well, yeah, it certainly was. Risk-off sentiment certainly prevailed over that session. In fact, we've seen that with Bitcoin taking a big leg lower. Marcus, we're interested to see what you think that is indicating. Gold also off as well?
Yes, gold off as well. And I think if the market needs to be seriously worried about the US bond market for gold and Bitcoin to continue to do well. And I think sentiment on that has peaked. 30-year bond yields have been coming off consistently. The market's no longer so worried about $37 trillion worth of debt and the US losing control of the bond market. So they've peaked. And I think the only thing the great thing about Bitcoin and gold is it's got no earnings. So you can never say it's expensive. It's just people running around an inert lump of metal or some blockchain and deciding what it's worth. So gold could go anywhere. So it is quite technical. And I think if I was a central bank driving the gold price higher, I would have said, we should just back off. It's getting overheated. Let's just back off. We'll get it cheaper later on. Let's let the retail mania frenzy die, and then we'll start buying again. So I don't think gold and Bitcoin's sell-off is going to be significant. I think the underlying drivers are still there. China's buying a lot of gold. There's a lot of central bank buying, and there's still risks out there which favor gold. So technical correction, I would say. Same with Bitcoin. The two tend to go hand in hand. Gold has got seemingly solid underlying drivers. It's just frenzied. So technical correction for now, I think. That's all.
Now, Marcus, of course, you liquidated your ETF holdings. You went 100% cash. Just, are you still holding that position at the moment?
Andrew, we are. We sold $70 million worth. Our fund's now got $79 million in it, but we sold $70 million worth of ETFs in one day. We thought we were going to have terrible liquidity. Well, we didn't. We talked to all the ETF providers, but there was a risk that we had liquidity problems on the day. Turns out they went through. Prices were 3 out of 4 were above VWAP, so our execution was really good. And the one that wasn't was 0.04% below VWAP. So no liquidity problems. We cashed out after that 3.5% drop on the NASDAQ on the back of what we knew was a temporary thing, which was Trump's tweet over China. But we had been thinking about doing something we don't usually do, which is preemptively sell before the top. And then a top appeared to arrive. So we sold. I think we have basically overexposed to big tech. Some of our investors were saying that as well, feel a bit overexposed to big tech. We held Semi-FANG, IVV, and the NASDAQ or U100 ETF. With all that bubble talk and a big week of uncertainty last week with big tech results, we sold out. And we're looking now for a buying opportunity. As I say, there's nothing seismically wrong with big tech other than price. So I don't think we will wait on something precipitous. We'll just look for a buying opportunity, I think, in big tech when all this bubble talk's cooled down.
Now let's turn to the local markets. Marcus, of course, in the wake of the RBA leaving rates on hold, that was expected off the back of that inflation read. What effect is that likely to have, particularly on the equity market going forward, do you think?
Well, it's not a great driver for Australian equities, although I've got to say the Australian equity market is resources, banks and the rest. So it's not a homogenous group, our market, and we would look at each sector individually. As far as the bank sector is concerned, which has responded negatively to the idea that rates are not going to come down. As far as that's concerned, it coincides with their results season, which started very well with Westpac yesterday. But the bank sector does tend to rally into results for just over a month and then peak just before results. And then the dividends come and go ex-dividend, so the prices fall a bit. But usually they peak just ahead of results. And here we are with the MVB ETF, which takes in the Big Four and Macquarie and Bendigo and Bank of Queensland. It's at its all-time high. So there's no bargain to be had in the banks at the moment. And this is traditionally where they sort of underperform for a while anyway. And then the market itself sort of peaks. And then the RBA is saying they're not going to be cutting rates. Some Macquarie's out this morning saying we may have seen the last rate cut in this cycle. Others are saying there's a 70% chance of a rate cut by mid-2026. But this is a bit of a negative for the bank sector, and this is traditionally the time it peaks. So Westpac results good, but you really can't expect with no earnings growth this sector to head off again. So I think great for income investors. They generally hand their kids to their shares to their kids anyway, so they're not concerned about where the price is. But good to see them at all-time highs. I think I'd feel sorry for all the people who have I think we had the highest investment loans growth rate last month than we've seen since, 2013 or something. People got pretty excited about the property market in the last few months, only to now get a slap in the face. They're the ones that are going to be thinking or suffering the most from that.